Welcome to EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretton. Today, we continue with our EIS Basics series, and we're talking about knowledge intensive funds. As a reminder, as well as the audio podcast version, you can also see a video version on YouTube for this series. So today, I am joined by Glen Stewart, who is Head of Business Development at Committed Capital. Welcome to the podcast, Glen.
Thank you very much indeed for having me, Brian. Good to be here.
It's our pleasure. So we had one of your colleagues way back on episode 23.
Crikey.
Like a long time ago.
Indeed.
But today we're glad to have you here. I think we'll start with something that we mentioned in a couple of other episodes, but what is a knowledge intensive company?
To qualify as a knowledge intensive company, companies must have no more than 500 full-time employees when EIS qualifying shares are issued versus the 250 limit for other EIS qualifying companies. And they need to pass several tests. So the first test considers innovation of the company and the skill set of employees. The company should be carrying out work to create intellectual property and expect the majority of their business to come from this within 10 years, or have 20% of employees carrying out research for at least 3 years from the date of investment. And these employees must be in a role that requires a relevant master's or higher degree. Additionally, companies must meet an operating cost condition and an age test. So the operating cost condition requires companies to spend money from their overall operating costs on R&D or innovation. And this should be either 10% a year for 3 years or 15% in one of 3 years. With regards to the age test, companies that do not qualify as knowledge intensive must receive investment within 7 years of their first commercial sale, whereas knowledge intensive companies can receive investment within 10 years of either their annual turnover going over £200,000 or their first commercial sale.
Okay. So all that's very detailed. It's excellent. Why do you think knowledge intensive companies actually have these higher limits compared to normal EIS companies?
Well, the government views knowledge intensive companies as crucial for economic growth, productivity, global competitiveness. And so the overarching purpose of higher investment limits for qualifying companies, and indeed scheme enhancements, of course, for investors, is to direct more private capital into innovative R&D intensive businesses to support the UK's innovation-driven growth strategy that they keep talking about, particularly when we're approaching budgets and so on, which is not very far away now, thereby maintaining our competitive position internationally. So knowledge-intensive companies can raise up to 10 million a year, which is double the regular EIS qualification, and can raise up to 20 million under EIS in their lifetime rather than 12 million under regular EIS. And investors, from an investment perspective, they can invest up to 2 million a year in knowledge intensive companies, which is double the usual EIS limit of 1 million.
Okay. So yeah. So if you're a substantial investor, they've definitely got some additional advantage.
Yeah.
So we've got this structure called an approved knowledge intensive fund or a knowledge intensive EIS fund. What actually is that?
A KI fund can either be approved or unapproved. Haven't seen any unapproved funds in the market, of course. It's not necessary to obtain such approval for an investment fund, but there's certain advantages of seeking approval from HMRC of the fund. In particular, investors can obtain income tax relief earlier than if the fund has not been approved. And an HMRC approved fund must be managed by someone authorized to carry on investment business, so typically a firm regulated by the FCA. And to obtain approval, the entity managing the fund must make certain commitments. So at least 80% of the fund's capital being invested into knowledge-intensive companies at the time the shares are issued, and investing 50% of the fund's capital within 12 months of the fund closing, and then finally investing 90% of the fund within 24 months of the fund close date.
And you mentioned about income tax. When do investors actually get the income tax?
Well, one of the key benefits of knowledge intensive EIS funds, providing those requirements are of course met, is that investments are treated for income tax purposes as though they were made on the date the fund closes, rather than when each underlying investment is ultimately made from the fund under a discretionary basis that might usually be the case. So obviously this is a significant benefit for timing certainty and from a tax planning perspective. So, for example, if the fund closes on the 5th of April 2026, the investment is treated for income tax purposes as having been fully deployed on the date that the fund closes. So the investor in that instance can claim income tax relief in the tax year of investment, 25-26, or the previous tax year, 24-25. But from an actual cash flow perspective, investors can only claim income tax relief when they receive their EIS 5 tax certificate. So when this happens is down in a large part to the deployment timeframes of the fund manager. It also in part to how long HMRC are taking to respond to compliance certificates. And so targeted deployment timeframes should certainly be taken into consideration by investors.
Yeah, and certainly I think that's something we can see across the market where people have a variety of deployment times where some are relatively short. I think you're at the shorter end, where some can take, they're targeting kind of 15 months, which means by the time you get EIS 5, it could actually be 18 months or 2 years after that initial date before you get the EIS 5. So the time is can actually be slightly delayed.
Yeah, absolutely. And a lot of not just investment cash drag, but then tax relief cash drag as a consequence. So I think when we looked at the market before we came into the market, deployment timeframes averaged between, at one end, I think 6 months, and at the other end, 24 months. So it is something that's very much needs to be considered.
Yeah. I know from personal experience, the one KI fund I invested in did take a little bit of time. So you mentioned about claiming income tax relief. You and the EIS 5 certificate. How does that work?
Well, it's one of the key benefits of KI funds is that investors just receive one certificate, being an EIS 5, rather than multiple EIS 3s for all of the various companies they've invested into. The mechanics of claiming income tax relief are very straightforward and broadly the same as for regular EIS funds, with investors being able to claim income tax relief on the self-assessment tax return, which is always the preferred method, because then it's in the investor's control to an extent as to when they get their money back. But for investors looking to claim income tax relief for a previous tax year, for which they either didn't receive a tax return or they've received a tax return, they've already submitted it to HMRC, they can fill in section 3 on page 3 of the EIS 5 certificate and send that to their tax office. And that will be treated as essentially amending the tax return previously filed if it's already been filed. And then finally, where a fund closes during the tax year, rather than at the end of the tax year, and the investor pays tax under PAYE, they can request a PAYE coding notice adjustment. And again, that's on page 3 of the EIS 5 certificate as well. And they simply submit that to the tax office.
So what's the ways to get money back from the government?
Indeed.
Always like that. So I suppose the other question was people wonder, in the previous episode, we covered the tax release for EIS. And if anyone's interested, I suggest you can go back and listen or look at that. How does this fund structure actually affect those reliefs?
Well, all other tax reliefs operate in the same way as for regular EIS funds, although it is, so loss relief is the same, CGT deferral, although it's important to note, to avoid any confusion, that for CGT deferral purposes, it is still the date that the shares are subscribed for in underlying companies, rather than the date the fund closes for income tax purposes that is relevant for CGT purposes, in the same way that it is for regular EIS funds. So It's just a word of caution not to perhaps think that CGT deferral in a KI fund follows income tax relief in a KI fund.
Yeah. And again, that means you've got to watch deployment times. It's a relatively wide window.
It is a relatively wide window. So yeah, for investors with a time-sensitive CGT deferral window approaching the 36-month time limit, it's certainly something to be considered.
So, in summary, what do you think are the attractions for advisors, investors in KI relative to an EIS fund? And are there any disadvantages?
Starting off with advantages, access to a portfolio of hopefully innovative and potentially high growth stage companies, higher investment limit of 2 million a year versus 1 million for regular EIS, quicker income tax relief, subject to, of course, as I mentioned, fund managers' targeted deployment timeframe, and certainty of timing from an income tax relief perspective. And then, of course, finally, from an admin perspective, just having one EIS 5 certificate to claim the tax reliefs on rather than a multitude of EIS 3 certificates is advantageous from a tracking and admin perspective. From a disadvantage perspective, I suppose the only one I can really think of potentially is for a client that is a CGT deferral case that is time sensitive, that they may want to look at a fund that can deploy funds straight away ahead of that time limit, whereas a knowledge intensive fund, being a closed-ended fund, will not deploy funds until the fund closes, and that might therefore miss the time sensitive capital gains tax deferral window.
Okay, so that's something for people to watch out for. Well, thank you for all that, Glenn. If anyone wants to find out more about Committed Capital, where should they go?
committedcapital.co.uk is the website. Email address info@committedcapital.co.uk, or myself, Glen.Stewart at committedcapital.co.uk, or phone on 0207 529 1350.
Thank you very much. We will put links to all of those in the show notes, and we will also include a link to, if people want to read up on these sort of rules, we'll post a link to where you can find them. So thank you very much, Glenn.
Thank you very much.
For viewers and listeners, as usual, you can get the full show notes with links at harmonandco.com/podcast. You can subscribe to podcasts and all good podcast players. Also, the link in the show notes, and for this series, you can see it on YouTube as well. So you can subscribe to Hardman Talks on YouTube. If you like what you hear, tell a friend or a colleague, or give us a really nice review on your favorite podcast app. We can be contacted at inquiries@harmonandco.com. Thanks for listening, and we'll have our next EIS Basics episode in a week's time.